Becky Cantley here, and in this video, I'm going to talk about what you need to be thinking about in light of the Biden administration's tsunami of proposed tax hikes targeting corporations and the wealthy. I'm going to cover income tax increases for higher earners, changes in the estate tax and the impact on inherited assets, the increase to the corporate tax rate, the proposed capital gains rate increase, elimination of key real estate tax breaks, and many more areas that are on the table that could have a significant impact on all of you. If you are someone with significant assets, say 2 million or more in net worth, stay tuned. I'm Becky Cantley, author, professor of tax law, and senior partner at the Cantley Dietrich Law Firm. Okay, let's get started. Okay, so first we're going to talk about the corporate tax rate changes. The Biden administration recently announced the American Jobs Plan, which is an infrastructure bill aimed at spending trillions of dollars on roadways, bridges, et cetera, plus a whole lot of other priorities that the Biden administration thinks are important. And to offset the high price tag, they have proposed a significant number of corporate income tax rate changes that should raise a lot of revenue over a decade. First, they have proposed raising the corporate income tax rate from 21% to 28%. Now, while that seems like a significant rise in rates, and it is, the reality is that when President Trump came into office, the tax rate was 35%. So it's still significantly lower than it was when President Trump came into office, should they get the entire increase passed through legislation and signed into the tax code. Another proposal is a 21% global minimum tax, calculated country by country. U.S. corporations would pay 21% on overseas income in each country that they do business in. In addition, they proposed a 15% corporate alternative minimum tax on corporations with global book income of $100 million or more. So many large corporations would end up paying at least a 15% tax rate on the book income that they show to investors. So if you're a corporate taxpayer and you're facing these kinds of very significant rate hikes, what can you do about it? Well, the only thing that makes common sense would be to defer your taxes to later years when hopefully we will have folks that decide to reduce rates again. These kinds of high rates don't tend to stay around for a very long period of time. So you would want to outlast the government by creating a deferral. Another code section that the Biden administration is seeking to change is the recently enacted Section 199A deduction. That deduction provides for a 20% pass-through deduction for qualified business income. The Biden administration is proposing phasing it out for taxpayers who make more than $400,000 of adjusted gross income. So if you make more than $400,000, you're going to eventually end up not being able to take advantage of this Trump era provision. The 199A deduction is a below-the-line deduction available to owners of sole proprietorships, partnerships, S corps, and some trusts and estates engaged in a qualified business. The only solution for a phase out of the 199A deduction would be to be creative in locating additional deductions that could create the same kind of offset so that your taxes remain stable. The Biden administration is also raising the top personal income tax rate. The current rate as 37% will be raised to 39.6% for people making more than $1 million. So this is not a massive increase in actual rates, but will raise a significant amount of revenue. The only solution for a high-end taxpayer would be to undertake a strategy for deferring the income to later years when hopefully the rate will come down, and or doing a conversion strategy which would take some of the ordinary income and turn it into a capital gain. The idea would be to defer the income until capital gains rates are low again, given that the Biden administration is also proposing raising capital gains rates significantly. The Biden administration is going to propose a capital gains tax rate increase that's very significant. Currently, capital gains are taxed at a preferred rate of 20%, and the Biden administration would like to raise that to the top income tax rate. Currently at 37%, they have also proposed, of course, that that rate increases to 39.6% for taxpayers making more than $1 million in income. Capital gains tax rate is a preferred rate in which assets that are sold at a gain that have been held for more than a year are taxed at a preferred rate of 20%. The Biden administration is proposing that that rate for people that make more than 1 million in income rise to the top level of taxation for that class. So, for example, right now the top tax rate is 37%. The Biden administration is proposing it be raised to 39.6%. If it were successful, capital gains for this class of taxpayer would be at 39.6% rather than the 20% it is today. That is a very significant increase. The Biden administration has also proposed raising the Social Security tax rate for employers and employees. Currently, Social Security taxes are applied to the first $137,700 of wages/income, and that number is inflation indexed each year. The Biden administration is planning on over $400,000 being taxed at an additional 12.4%. In application, this means there is no Social Security tax on the income between the current cap on Social Security, which is $137,700, and the $400,000 in which the new tax rate would apply. Itemized deductions. So the Biden administration is also proposing reducing the benefit of itemized deductions such that nobody receives a benefit of more than 28%. Itemized deductions are things like medical, dental, real estate taxes, state taxes, home mortgage interest, mortgage insurance, charitable gifts, casualty, theft losses, etc. In application, this is a reintroduction of the PISA limitation, reducing itemized deductions by 3% for each dollar of income in excess of $400,000. The Biden administration has made significant proposed changes to the estate tax code. For example, the estate tax exemption is being proposed to be reduced from 11.58 million to 3.5 million. That is a giant reduction in the estate tax exemption. That will bring an enormous amount of estates into the estate tax world, wherein most estates were not previously. It increases the top tax rate for estates to 45%. Most importantly, they have proposals both in the House and the Senate right now to eliminate the step up in basis for beneficiaries who receive $1 million in either income or benefit or property during the year that the decedent passes away. Today, when someone passes away, the value of the assets in the estate that a beneficiary receives is stepped up to the current fair market value of the asset. So, for example, if you own some property, some investment property that is worth $1 million, but the only cost you $500,000, you have a $500,000 gain in that property if you sold it. But because the decedent passes away, it's treated as though it's stepped up to the full 1 million, and you pay no tax on what would otherwise be a capital gain, the capital gain for the sale of the asset. So now that we understand what the step up in basis is, let's look at the proposal that the Biden administration has on the table in the Senate and the House. They're proposing that beneficiaries making $1 million in the year of the date of death of the decedent do not get the step up in basis, and instead must pay tax on the assets as though they were sold on that date in the amount of the difference between the basis of the decedent and the amount the amount that is the fair market value of the asset. Now, if you combine this step up in basis elimination with the higher capital gains rate that the Biden administration is proposing, there could be as much as an $80 billion increase in annual taxes. The Biden administration has also proposed changing the rules with respect to like-kind exchanges. Like-kind exchanges are typically where you have property held for business, often real property, and you have a sale of one piece of property and a purchase of a like-kind piece of property on the other side, and you don't end up paying capital gains tax or you don't end up paying income tax on the sale of the asset. It rolls into the new property, and you take the same lower basis that you would have in the initial property that was sold into the new property that's acquired. The Biden administration has decided to propose that taxpayers making more than $400,000 a year can no longer make use of like-kind exchanges. So that's it. A quick look at some of the tax proposals on the table that could have a huge impact on your wealth. In future videos, we'll start to look at each of the areas to give you some wealth protection strategies to think about. If you like this video, please make sure to subscribe to my YouTube channel right now. Just click on the subscribe button below this video. Also, if you are a high net worth individual or advisor looking for tax strategies and tax law insights for protecting your wealth, head over to the CantleyDietrich.com website and follow our blog.